Hello, everybody, and welcome to Chapter 3. This chapter is about analyzing and recording transactions. These are the concepts we're going to go through, so let's dive in. All right, so we're going to ground our discussion in real world by talking about the set of rules. First and foremost, the U.S. primarily uses the standard for financial reporting is the Financial Accounting Standard Board, which is the FASB. Now, it's critical to understand that the FASB is not a government body. It's an independent nonprofit organization whose board members are drawn from academia, auditing, and corporate accounting. Its mission is to establish and improve standards of financial accounting and reporting for the public interest. Now, these standards are what we collectively refer to as the GAAP, or the Generally Accepted Accounting Principle. So why do companies follow them? Well, the answer lies in the Security and Exchange Commission, which is the SEC. The SEC is a government agency whose primary purpose is to protect investors, maintain fair, orderly, and efficient markets. So the SEC has legal authority to mandate accounting standards for all publicly traded companies. However, for decades, it has delegated this responsibility to the FASB. So the SEC effectively says, if you're a public company, you must prepare the financial statements using GAAP. What about the global stage? Well, many countries use the International Financial Reporting Standards, which are set by International Accounting Standard Board, the IASB. And the key difference is, which is a significant topic, by the way, in advanced accounting, but for now, the key difference is that GAAP is a more rule-based system, often very specific, detailed guidance for particular transactions. So the IFRS, on the other hand, is more principle-based system, relying on a broad framework and requiring more professional judgment. So for now, and going through this semester, we will focus on GAAP because that's where we are at. Now let's delve into the intellectual foundation of GAAP. And these are not just attributes, are not attributes, but arbitrary rules. But rather they are conceptual frameworks. They're designed to make financial statements useful, reliable, and comparable. The first is the revenue recognition principle. And this is a powerful idea. Now, revenue is recognized when it is earned, not necessarily when cash is received. So to be earned, a company must have substantially completed the service or delivered the product. For example, if you are a contractor building a house, you don't recognize all the revenue from the client when your client gives you the deposit. That's just a deposit. You recognize it progressively as you complete the stages of the work, because that's when you have earned the right to that revenue. Now, there's also expense recognition principle, and it's often called the matching principle. It is the counterpart for revenue recognition. And so it says we must match expenses with revenue they helped generate in the same accounting period. So if a company sells a product in January, it also recognizes that the expense in January, even if the supplier was paid in December. The second one that we have, or the next one that we have, is the cost principle. And the cost principle is about historical cost. It mandates that we record assets as their original cost at the time of acquisition. Now, this brings a high degree of objectivity. Essentially, because the cost is verifiable, we have objectivity in this case. So we don't adjust the assets to their current market value, which can be subjective and volatile. And finally, the last one is the full disclosure principle, and it is the ethical core of accounting. It requires that a company discloses any and all information that would be material to an informed user decision making. This includes not just the number of statements, but also the critical details in the footnotes, such as pending lawsuits or significant changes in the matter. So these are the full disclosures that we have. Let's continue to build on this framework. The separate entity concept is fundamental. It means a business's finances are completely distinct from the owner's personal finance. This is why you never see a homeowner's mortgage on a company's balance sheet. The conservatism principle is about prudence. If you have to make an estimate and there's uncertainty, you should always err on the side of caution. For example, when valuing inventory, you'd use the lower cost or market value. The monetary measurement is a given, sorry. Everything must be quantifiable, is a stable monetary unit like the US dollar. We can't express the value in labor hours or units of output on the financial statement. So it has to be expressed as a monetary measurement. For the going concern assumption, it is the basic for all the valuation and reporting. So it's the assumption that the business will continue to operate indefinitely. If we believe the company is going out of business, the entire reporting approach would change. And finally, the time period assumption allows us to slice up the life of a business into discrete periods like quarters or a year to provide timely and useful financial information. It's what allows us to produce quarterly reports. All right, so what you see here is really a great visual. It is the intellectual architecture of GAAP. Notice how the SEC and the FASB sit at the top, directing the standards below them, and you see the principles, assumptions we just discussed. They all work together to form a cohesive system. So you want to think of it as the DNA of the financial accounting. Every transaction and every financial statement is built on these concepts. Let's get to the bedrock of all of this, you guys, the accounting equation. Now, this accounting equation is going to come up more and more and more times. It is deceptively simple, okay? Very deceptively simple because things get complicated. Assets equals liability plus owner's equity. That's what we know. Assets equal liability plus owner's equity. This equation must always, always, always be in balance. Assets are the resources a company owns, like cash, inventory, and buildings. Liabilities are what the company owes to the external parties, like banks and suppliers. Owner's equity represents the owner's residual claim on the asset after all the liabilities have been paid. From here on out, we'll primarily be using the term stockholders' equity, focusing on corporations. So stockholders' equity includes things like common stock and retained earnings, okay? This is what we are going to title it. So now, the core methodology for recording transaction is called the double entry bookkeeping. This system is built on two key components, accounting and general ledger. An account is a specific record for each item, like cash account or salary expenses account. The general ledger is the master file that holds all these accounts. The double entry part means that for every transaction, there must be a change in at least two accounts. That's two accounts. This is how we ensure that the accounting equation remains balanced. More specifically, for every transaction, the sum of the debit must always equal to the sum of the credit. And these are different than your debit card. These are different than your credit card. Ignore that meaning for now. This is the internal checks and balances system for accounting. All right, now let's demystify debits and credit. This is where many students get super confused because it's simpler than you think, okay? But it seems confusing, but it's not. Debit, which we denote as DR, is simply the left side of an account, and credit is the right side of the account. That's it. They are not synonymous for increase and decrease. That's not what they are. What they do depends on the type of the account. What do we got? DR is on the left side and CR is on the right side. The visual representation that we use to organize this is called the T account. It's a simple T shape with the account name on top. So debits go on the left, as we said, credits go on the right, and this is the basic building block for tracking all the transaction. All right. You can see it here a little bit more. Now, this table here is your Rosetta Stone of accounting. This is something that you have to internalize and really just keep in the back of your mind. And as we said, a debit or credit effect depends on the account type. For assets, a debit increases the account and the credit decreases it. So again, for assets, the debit increases the account and the credit decreases it. This is their normal balance. For liability and equity, it is the opposite. A credit increases the account and a debit decreases it. This is their normal balance. Now, within equity, we have a little more detail. We have common stock and we have revenues, which work like a liability. They increase with credit. However, dividends and expenses are what we call contra equity accounts, and they reduce the overall equity for a company. So they have the normal debit balance, meaning the debit increase. And so this provides the absolute rule we will need for the rest of the course. You want to study it, you want to understand it, you want to practice it. This is it. We have to know this information. This is the most important information that you need because it's our building block. All right? Okay. So let's continue. Let's formalize what we just covered about debits and credits. And so the concept of normal balance is critical. Normal balance is simply the side of the account, either debit or credit, that is expenses expected to have a positive or increasing balance. You want to think of it as the natural state of an account. For an asset account, the normal balance is a debit. This means an increase in an asset, like cash or inventory, is recorded with the debit. A decrease is recorded with the credit. For a liability account and all of the equity, the normal balance is a credit. So for an increase in liability, like a loan, is a credit. Within the equity category, we have some important sub-accounts. So common stocks and revenue both increase equity, so their normal balance is credit. And then we have dividend and expenses, which decrease equity. Because they have the opposite effect on equity, they have a normal debit balance. An increase in an expense, for example, is a debit. Now let's take a closer look at the expanded accounting equation. We know that assets equal liability. That we know, but we're going to get a little bit more complicated there. So we've already established that equity is composed or comprised of contributed capital and retained earnings. Let's break that down a little bit further. So what do we have? We have assets equals liability plus equity, and equity has these branches, and equity is divided into these subcategories. Two, I want to call them headers, which is contributed capital and retained earnings. Contributed capital is the money that the owner has directly invested into the business. So a common stock example is the sales of common stock. Okay? So again, the money that the owner has directly invested in the business. Retained earnings is the money that the owner, are the profits that the company has earned over its lifetime and has chosen to reinvest back into the business rather than pay out dividends. Retained earnings are increased by revenue and decreased by expenses and dividends. Okay, so you kind of can see it. What do we have? Assets equal liability plus stock, so common stock, minus retained earnings, which would be dividends plus revenues minus expenses. That's how we break it up, okay? So this diagram is just a visual roadmap for understanding how the pieces of the accounting puzzle fit together. You can see how the basic equation expands to show the details within the equity section. So this is a powerful tool for analyzing transactions. Any change in revenue, expenses, or dividend account will ultimately flow through the retained earnings and therefore affect the overall equity of the company. All right, so let's get specific and define some of the most common asset accounts. First and foremost, cash. This is the most liquid asset. It includes not just physical currency, but also checking accounts and money orders. It is the lifeblood of a company. So that's the first one. Then we have accounts receivable. These represent the money owed to the company by the customers for goods and services that they have delivered but not yet paid for. Think of it as a promise of cash in the near future. Inventory. These are the goods a company holds for sale to its customers. They are assets until they're sold, at which point the cost is moved into the income statement as an expense. Supplies, this includes items used in daily operations like office supplies or cleaning supplies. They are considered assets until they are used up, at which point they become an expense. Then we have prepaid expenses. This is an asset created when a company pays for a service in advance. So for example, if a company pays for a year insurance upfront, that payment is prepaid expense. It will be used up and converted into expenses over the 12-month period. Notes receivable is similar to account receivable, but it's typically more formal, written promises to pay money, often with interest and specific terms, and it usually arises from a loan company has made to another party. Equipment, this includes long-term tangible assets like desks, chairs, machinery, and computers. They have a useful life of more than 1 year. These assets will lose value over time in a process we call depreciation. Now, these are all long-term assets, like buildings, machine, and land. Long-term assets, buildings, machinery, like equipment, will depreciate over time, but it's a critical concept to remember that land is not depreciated because it's considered to have indefinite useful life. So this is how buildings are, or land is different. I just want to say that this picture is really cool for multiple reasons. What you are seeing in the money pile, I want to say that's the Lebanese lira, which is very exciting for me because I'm Lebanese, and that is a very, very old currency that we no longer use as paper. Actually, I don't think they use it as coins at this point either because of the economic collapse that happened back in 2019. But nevertheless, the fact that it's there is pretty cool. Okay. What are we looking at? Well, we have this visual representation of some of the asset accounts we just discussed. So in the top left, we have cash, which is liquid asset. Top right, we have buildings, long-term assets. Left, inventory, the goods a company has available for sale. And the bottom right, we have a robotic arm, which we considered a piece of equipment or machinery. Just as we have a variety of asset accounts, we also have different types of liability accounts. Remember, liability represents what a company owes outside of itself to outside parties, right? So account payable, this is a very common liability. It represents the money owed by the company, typically for suppliers, for goods or services it has received on credit. It is the inverse of accounts receivable. Notes payable, similar to accounts payable, but it's based on a formal written agreement or promissory note. It typically has a longer term and includes interest. For example, a bank loan would be recorded as notes payable. Unearned revenue, this is particularly important concept. It is a liability that arises when a company receives cash from a customer for a product or a service that it has not yet delivered or earned. The company is now liable to the customer to either provide the goods and services or return the money. Once the service is performed on the product delivery, the unearned revenue liability account will decrease and the revenue account will increase. This perfectly illustrates the revenue recognition principle in action. Okay, now let's break down the concept or the component of stockholders' equity. This is the third part of our fundamental equation, representing the owner's claim on the company's assets. Stockholder company is comprised of two primary components, which we talked about earlier, but we're going to say it again until it's super clear to all of us. First, you've got contributed capital. This is the direct investment made by the owner or the stockholder in the business. The most common example is the sales of stock or inventory. This cash is used by the business to grow and develop operations. Second is retained earning. This represents the total amount of income that the business has earned over its entire lifetime that has not yet been paid out to the owners as dividends. Think of it as the company's cumulative profit that has been reinvested in the business. Retained earnings are critical indicators of a company's profitability and financial health. A company with growing retained earnings is a company that is consistently profitable and successfully reinvesting those profits back into the business to create more value for its owners. All right, let's bring it all together. Take a look at this diagram. This is one of the most powerful and insightful models you will see in all of your introductory accounting class. It beautifully illustrates the relationship between interrelationships between core financial statement and expanded accounting equation. We started with the basic, right? Assets equal liability plus owner's equity. We call it stockholders' equity now. All right? And that is the balance sheet. It is the snapshot of a company's financial position at a single point. Now, look at how the equity section expanded. The statement of stockholders' equity shows a change in equity, which are driven by contributed capital and retained earnings. Cool? So you can kind of see it visually. This statement provides the details needed to arrive at the final equation or equity number on the balance sheet. Finally, look inside the retained earnings. It's composed of beginning retained earnings plus net income minus dividend. And what is the net income? Well, it's revenue minus expenses, which is the core of the income statement. This is how they build on each other. You can see it. We have the income statement, we have the owner's equity statement or statement of owner's equity, statement of stockholders' equity, whatever you want to call it, and then the balance sheet. So you can see how they build on each other. You first need to do what's inside the smaller parenthesis, then what's inside the bigger bracket, then you can get to the final balance sheet or the final equation, which is pretty awesome to be able to do in that sense. All right, so continuing on with this one, this exercise is going to be filmed in another video, so we're not going to worry too much about it in this time. We'll work out those anytime you see sample exercise, we will work it out in a separate video. All right. So moving into the module, we're going to talk about accounting cycles here. And so the accounting cycle is not just a list of steps; it is a systematic step-by-step process that processes use records. Sorry, I had to check if the microphone's working. All right, so the accounting cycle is not just a list of steps. It is a systematic step-by-step process used to record all business financial activities during an accounting period, such as a month, a quarter, or a year. The goal is to keep financial records up to date and accurate, accumulating, there we go, in the creation of the financial statements. Now, you want to think of it as an engine of the company's financial records. Okay, so we will focus on the initial steps, which are crucial for getting our data right from the start. Once the cycle is complete, it begins all over again in the next accounting period. This is our cycle. Now, this diagram shows the complete accounting cycle. It's a particular process because it repeats every accounting period. We start with identifying and analyzing transactions and end with preparing post-closing trial statement with optional reversing entities. And so the entire cycle is designed for one primary purpose: to organize financial data and to make it easily accessible to both internal and external users. So these are external users like investors, creditors, that need to identify or evaluate the company's performance and financial health, and internal users like managers who need it for decision making. So here are the 4 steps that we have. All right, so step 1 is to identify and analyze transactions. This is the starting point. Every business activity, from a scale to a utility payment, is a transaction. We must first identify a transaction by looking at its original source documents, such as sales receipts, invoices, or bank statements. We then analyze it to determine if its value and how it will impact the accounting equation. Step number 2, record the transaction in a journal. So step 1, identify and analyze the transaction, which is what we're going to do. Step 2, record the transaction in a journal. So once a transaction is analyzed, we record it chronologically in the general journal. This is the company's first formal records of every transaction. This is where we apply the rule of debit and credit in the recording that we learned earlier. Now, step number 3 is to post journal information to the ledger. After we record transactions in the journal, we must transfer or post them on a general ledger. A ledger is not chronological. Instead, it organizes all of the transactions in the accounts, and this step allows us to see the total balance of each individual account, like cash or account payable, at any given time. Step 4 is to prepare the unadjusted trial balance. Once all the transaction has been posted from the journal to the ledger, we create a trial balance. This is a list of all account balances. The purpose of this step is to prove that the total debit equals the total credit. It is the first check on accuracy of our work. If debit and credit don't balance, we know we've made a mistake and must find it before we move on. Let's take a closer look at the general journal from step 2. As you see, it's a simple format with columns of date, account title, as well as, debit and credit. It's a chronological log of every transaction. So if a business needs to look up every event that happened on a specific day, they would go to the journal. The journal provides a complete history of all the business activities in order that they occur. Recording transactions in a journal is often called journalizing. It's kind of like when you're looking through your bank statements and it's organized, or you're filtering by date. Essentially, that's what it is. You're filtering the transactions by date. Next, we have the general ledger, which is the destination for the information from the journal. Remember, the journal is chronological, but the ledger is organized by account. The best way to visualize the ledger is using the T accounts. For every account, like account receivable or cleaning revenues, we will have a T account. When we post a transaction from the journal, we're simply transferring the debt or the credit, the debit or the credit amount to the corresponding T account. The balance of each T account will be the running total of all transactions that have affected that account. The final balances are what we will use to create our trial balance. This would be an example of the, my apologies, unadjusted trial balance that is created in step 4. You can see it as it's a simple list of every account from the general ledger and its financial balance. All accounts with normal debit balance, such as assets, dividends, and their expenses, are listed in the debit column. All accounts with normal credit balance, such as liabilities, common stocks, and revenues, are listed in the credit column. The most important part of this document is at the bottom line. The total of all debits must equal the total of all credits. If these two numbers match, it means our debit and credit have been correctly balanced for every transaction, and we can proceed to the next step of the accounting cycle. This is powerful internal control. All right, so this is, my apologies, one second. So let's walk through an example for the first step of the accounting cycle called analyzing a transaction. This is where we apply the accounting equation. A business transaction is an event that has a quantifiable effect on the financial statement. For every transaction, we must determine what the transaction is, then identify which accounts are affected, and finally determine how they are affected or how do they increase or decrease. So for example, let's say a company pays a bill. We need to analyze how it affects their cash and their liability. This process or this step really is a very important step, because if you misinterpret the transaction, all subsequent steps will be incorrect. So this is where we really just have to pay attention to it. All right, we will skip this one. All right. One second, my friends, I have to double check something. So let's apply our analysis to a concrete example. Transaction number 1 is issue 20,000 shares of common stocks for cash. Really, let me double check something. No, it's a different one. Okay. First, let's identify the accounts involved. The company receives cash, which is, as we said, an asset. At that time, or at the same time, it issues common stocks, which is a component of shareholders' equity. So the issues 20,000 common shares for cash, right? That's what we have. So now let's analyze the impact. The company's cash is increasing by 20,000. So we'll show a plus 20,000 under assets column because the company issued common stocks. The investment from owners is increasing. So as it's increasing, so we will also show a plus under the equity column. Okay, so what do we have? We have equity is increased by 20,000 in forms of cash. That means cash is an asset, which means that assets increase by 20. Notice the accounting equation remains in balance, right? So we have the plus 20,000 on one side, plus 20,000 on the other side, which is how we confirm that our accounting is correct. Now here's another example. This is transaction number 2. We purchase equipment on the account for 3,500, okay, with payments due in the next month. This is what we have. First, what are accounts? The company received equipment. which is an asset. It did not pay cash immediately. Instead, it incurred a debt, which means it's an account payable, which is a liability. Now for the analysis, the company equipment is increasing by 3,500. So we have a plus under the 3,500 in assets because the company did not pay cash and now owes money. Its account payable is increasing by 3,500. So we show that under the liabilities. Again, the equation is balanced. Assets increased by 3,500, liability increased by the same amount. Next, we have transaction number 3, and that is receives 4,000 cash in advance from a customer for a service not yet rendered. What are the accounts? The company received cash, and cash is an asset. It has not yet provided the service to the revenue recognition. So the revenue recognition principle tells us it has not earned the revenue. Instead, the company has a liability to the customer, and this is called unearned revenue. Okay, so while it becomes earned revenue and assets after, right now it is under liability because we're liable for $4,000 worth of service. This analysis, or the analysis that we have, the company's cash is increasing by $4,000. We record it as a plus under asset because that's what it's increasing under. At the same time, the company now has a liability, a promise to provide a future service. And so an unearned revenue account is increased by 4,000, and that shows a plus 4,000 under liability. So once again, the accounting equation remains in balance. So now let's analyze the transaction number 4. So transaction number 4 provides 5,500 in service to a customer who asks to be billed for the service. This is an example of accrual basis of accounting. The company has done the work, so we earned the revenue, even though it hasn't received the cash yet. So it's important to make a distinction to grasp. So the company's promise to pay creates an asset for the company called account receivable. And here's the breakdown of the impact of the accounting equation. Assets, which would be account receivable, is an asset. So it's increasing by 5,500. This represents the future economic benefit, the right to collect the cash from the customer. Liabilities, there is no impact on liability. So it has to impact equity. Now, equity in this case, it would be revenue. It is a component of equity, and it is increasing by 5,500. This is because the company has earned the revenue by profiting or performing the service. So the equation remains in balance, and assets increase by 5,500 and equity decreases by 5,500. All right, so now we are going to look at the next transaction. So transaction number 5 is pays a $300 utility bill with cash. First, the account. The company is paying with cash, which is an asset. So the cash account will decrease by 300. The payment is for the utility bill, which is a cost of business. These costs are recorded as expenses, and so specifically a utility expense account. These expenses are contra equity, meaning they reduce the company's equity. And so the expenses account will increase by 300, which in return causes the equity to decrease by 300. The equation is in balance. So assets decreased by 300, equity increased by 300. The journal entry would be debit. The utility would debit the utility expense account for 300 because it's an expense. These expenses have normal debit balance and are increasing. And the credits, the cash account, which would be 300 because the asset is decreasing. All right, transaction 6 distributed 100 in cash in dividend to stockholders. So our analysis starts with this: what account is involved? As per usual, what account is involved is cash, right? The company is paying in cash, which is a decrease in the asset by $100. The company is distributing dividends to stockholders. Remember, dividends are contra equity accounts that reduce the total equity of the company. So the dividend account, a component of equity, will decrease the company's equity by $100. This equation remains in balance. All right, so these are all all 6 transactions put together in one place. So if we take a look at all of these, you'll see each of the transactions we just talked about in its own column, and cash, accounts receivable, and equipment, we add them together, and they equal to 32,600. And then on the other side of the equation, we add the accounts payable, unearned revenues, common stocks, and then we we add the equity. So we add those together, and then we add the equity, dividend, revenues, plus expenses. We put them all together, and that gives us 32,600, which gives us a balanced equation. All right. So, let's put our analytical skills to the test with a practical example. We're going to use what we've learned about the accounting cycle and the definition of transaction to analyze some events for Debbie's dairy farm. Remember, the first step is always to identify and analyze the transaction. Where does it belong? So the key question to ask is, does this event have a financial impact that can be measured and recording in the accounting system? Let's take a look at event A. Debbie ordered shelving worth $750. Has a transaction occurred? No. An order is a commitment, but no goods or services have been exchanged yet. There is no change in asset, liability, or equity. We do not record this event. Now, event B. Debbie decided to increase her price to $3.25. Is this a transaction? No. This is a business decision, a change in strategy, but it has no direct financial impact that can be recorded. No money has changed hands, no assets have been acquired, no liability. What about event C? So, a customer buys a gallon of milk, paying cash. Yes, this is a transaction. Cash is an asset, it's increasing, and sale revenue, which is equity, is also increasing. This is a clear, measurable financial event. Finally, D. The shelving is delivered with invoice of $750. Is this a transaction? Absolutely. It absolutely is a transaction. The farm has received new assets, the shelvings, and has incurred a liability, account payable, because it now owes money for that shelving. And so this is where we see it kind of puts together. Again, you're going to see this exercise example in its own video. Now that we know what a transaction is, let's learn how to record it using journal entry. This is part of module 3.5, where we get into the nuts and bolts of bookkeeping. A journal is the first place we formally enter information into the accounting system. Think of it as the company's diary of all its financial events. There is a very specific universal format for the journal entries that you must learn to follow. 1, you always start with the date of the transaction. 2, the debit account titles must always come first and are listed flush with the left margin. Sorry, 1 second. Okay. To take care of something in the room. All right, so the credit account titles always come next and must be indented below the debit account. This indentation is critical formatting rule. You must have at least one debit and at least one credit. The total dollar value of the debit must equal the total dollar value of the credit. This is a non-negotiable in its essence of the double entry system. You will also write a short description after the account to explain the transaction. Finally, you skip a line after the entries, visually separate it from the next step. And this is the visual of what we just saw. So take a moment to look at how each of these components are placed. You have the date, you have the debit account first, credit account indented, you have the description, you have the debit, and you have the credit and the dollar values. This is in dollars as well. All right. Sometimes a single transaction will affect more than two accounts. When this happens, this is called a component entry. Sorry, a compound entry. A compound entry is simply a journal entry that has more than one account listed under the debit or credit column. Take a look at this example. Received cash and supply in exchange for common stocks. This is one transaction with a single cause, which is issuing common stocks, but affects multiple. So the company received two assets, the $3,000 in cash and $2,000 in supplies in a single transaction. It gave up one thing in return, which is $5,000 worth of common stocks. The rules remain the same. The debit must equal the credit. In this case, the total of the two debits, 3,000 plus 2,000 equals 5,000, which is the single credit of 5,000. So compound entries are very common and are handled the same way as simple entry, as long as the debit and the credit remain in balance. So let's bring everything we've learned together. We are going to apply the first three steps of the accounting cycles, analyzing, journalizing, and posting to a full month transaction for a fictional company called Printing Plus Incorporated. The list of the transaction for January is provided here. We'll go through each one of them and we'll analyze it together. So let's start with transaction number 1. On January 3rd, 2019, issued $20,000 shares of common stocks for cash. First, let's analyze the impact of the accounting equation. The company is receiving cash, which is an asset. So asset increased by $20,000. The company is also incurring common stocks, which is a part of stockholders' equity. So equity increases by $20,000. The equation, assets equal liability plus equity, remains perfectly balanced. Now we can create the entry, which I think we have them created in the next ones anyways. Oh, okay, there we go. Now we can look at these entries and you can kind of see where it's at, okay? All right, so let's move on to transaction number 2. So on January 5th, 2019, purchase equipment on account for $3,500, payment due within a month. First, the analysis. The company is receiving equipment, which is an asset. So an asset increased by $3,500. However, the company is not paying cash. Instead, it's promising to pay later, which is a liability. We will use the account payable. So liability increases by $3,500. Equity is not affected. The equation is balanced. Assets increase by $3,500 and liabilities increase by $3,500. Next, the journal entry. And so the equipment is an asset that is increasing. So we will debit the equipment for $3,500. Accounts payable is a liability that is increasing. So we will credit the accounts payable for $3,500. We will add description to recognize purchase of equipment on account. This is a classic example of a transaction that affects both sides of the accounting equation without involving cash. Next one is distributed $100 cash in dividends to stockholders. So our analysis starts with the account involved. The company is paying cash, so cash account, which is an asset, and that will decrease by $100. Oh, sorry, wrong one. Where's my 100? Oh, that's transaction number 6. Let me go back to transaction number 2. That's the one we just did. Okay, then transaction number 3 is where we are at. All right, so transaction number 3. On January 9th, 2019, receives $4,000 cash in advance from customer for service not yet rendered. This is a classic example of unearned revenue, and it tests our understanding of the revenue recognition principle. The company is getting cash, an asset, which will increase by $4,000. However, they haven't earned it yet. Instead, they have an obligation to the customer to pay for future, which creates a liability called unearned revenue, which is also increased by $4,000. So our journal entry will debit cash for $4,000 to show the increase in asset, will credit unearned revenue $4,000 to show a decrease in liability. As you see, the accounting equation remains perfectly balanced. Transaction number 4. On January 10th, 2019, provides $5,500 in service to a customer who asks to be billed for the service. The transaction is all about the accrual method of accounting. The company has earned the revenue by providing the service. They have not yet received the cash. This creates accounts receivable, which is an asset representing the customer's promise to pay. And so accounts receivable increases by $5,500. At the same time, the company has now earned the revenue, which is a key component of equity. So service revenue is increased by $5,500. Our journal entry will reflect this. So debit account receivable for $5,500 to show that increase in asset, and we credit service revenue for $5,500 because revenue increases equity. Again, the equation is balanced. Transaction number 5. On January 12th, 2019, pay $300 utility bill with cash. This transaction is straightforward expense transaction. The company's cash and asset decreases by $300. The cost of utility service is an expense, which is contra equity account. As we learned, expenses reduce the equity, so the utility expense account increases by $300, which turn reduces the overall equity of the company. So in our journal entry, we will debit utility expense for $300 to show the increase in expense account. We will credit cash for $300 to show the decrease in assets. The accounting equation, as you can see, remains balanced. Transaction number 6. On January 14th, 2019, distributed $100 cash in dividends to stockholders. So this transaction involves cash flowing out of the business to the owner. The company's cash and assets decreases by $100. So the distribution to the owner is a dividend, which is a contra equity account. And so dividends reduce retained earnings and therefore total equity. So the dividend account increases by $100, which results in a decrease of total equity. To record this, we will debit the dividend account for $100, since dividends have a normal debit balance as well. So now we will credit cash for $100 to show the decrease in assets, okay? And so again, the equation remains balanced for us. Transaction number 7. On January 17th, 2019, receives $2,800 cash from a customer for service rendered. This is simple. It's a simple revenue transaction where cash is received at the time of the service is performed. The company's cash and asset increases again by $2,800. At the same time, the company has earned service revenue, which increases equity. So the service revenue increased by $2,800. And so the journal entry is a debit to cash for $2,800 and a credit to service revenue for $2,800. Both credits, debit and credits, and overall accounting equations super in balance. We love that. All right. Transaction number 8 on January 18, 2019, paid in full with cash for equipment purchased on January 5th. So remember back on January 5th, we purchased equipment on account, which created account payable liability. Now we're paying off that liability. So the company's cash and asset is decreasing by 3,500. Accounts payable, a liability, is also decreasing by 3,500 because the company no longer owes that money. So the journal entry is a debit to account payable for 3,500 to show the decrease in liability. We will credit cash for 3,500 to show the decrease in asset. This transaction affects only the asset and the liability side of the equation, both decreasing in the same amount. Transaction number 9. On January 20th, 2019, paid 3,600 in cash in salary as well, salary expenses to employees. Now, this is a very, very common expense transaction. The company's cash and asset decreases by 3,600, and the payment of the salary is a business cost, so we'll increase the salary expenses account by 3,600. Remember, expenses are contra equity. The journal entry is a debit to salary expenses, so for 3,600, and a credit to cash for 3,600. All right, so next one, we have transaction number 10. And so on January 23rd, 2019, receive cash payment in full from customer on January 10 transaction. That's what we have. So this transaction relates back to transaction number 4. We previously recorded the service provided on account, which created an account receivable. Now the customer is paying that receivable. So the company's cash and asset increased by 5,500. The account receivable account, also an asset, decreases by 5,500 because the customer no longer owes that money. So the journal entry is a debit for cash for 5,500 to show an increase and a credit to account receivable for 5,500 to show the decrease. This transaction only affects the asset side of accounting equation, with one asset increasing and another decreasing, resulting in a net zero change for the total asset, okay? And we will put this together in a minute. Now, on January 27th, 2019, provides 1,200 in service to a customer who asks to be billed for the service. This is exactly like the transaction number 4. The company has earned revenue but hasn't received the cash. So we have new account receivable for 1,200, which increases the company's assets. So the company has earned service revenue, which increases the equity by 1,200. The journal entry is a debit to account receivable 1,200 and a credit to service revenue for 1,200. Again, this is another example of revenue recognition under the accrual method where the revenue is recorded when it is earned. And then we have transaction number 12 on January 30th, 2019, purchase supplies on account for $500, payment due within 3 months. The company is receiving supplies and assets, so which is an increase by 500. They're not paying cash, so this creates a liability. Accounts payable will also increase by 500. The journal entry is debit to supplies for 500 to show an increase in asset and a debit account payable for 500 to show an increase in liability. Again, the account remains in balance, and this is all of the transactions together as we have seen them. This is in chronological order as they would show up on a general journal. This is how it would look like. So for the month of January, this is what we did. These are the notes. These are the debits. These are the credits. That's it. That's all we're saying. This exercise will show up in its own video. So now we want to move on to step 2, which is posting transaction from the general journal to the general ledger. The purpose of posting is to take the chronological data from the journal and organize it by account. The general ledger is the collection of all company accounts. Posting is the act of transferring the debit and the credit account to the journal to their respective ledger account. Look at the first entry from January 3rd. We debit cash for 20,000 and credit common stock for 20,000. Now we post that debit into the cash ledger account and that common credit or that credit to the common stock ledger account. As you can see, each ledger account shows a running balance, which is a cumulative effect of all the transaction on that specific account. This is a crucial step that allows us to determine the final balance of each of the account at the end of the period. So these are all the transactions that affect the cash during January, right? So you have them listed. We have January 3rd, January 9, utility expenses, dividends, cash, accounts payable. These are all the things we listed as cash earlier. This also is the same information, but more formal ledger format, and it shows debit and the credit that affected the cash accounts chronologically, but we're still looking at chronological order, but these are all the things that affected the cash and the balance, the column that shows the running balance after each transaction is posted. So we have January 3rd, we debit 20,000, the balance is 20,000. Then we have January 9th, we debit 4,000, so now our total is 20,400. We then credit 300, we subtract that essentially from the balance, right? And so forth until we get, and this is kind of the running balance throughout the entire thing. This slide emphasizes the posting process, so the lines show how each individual journal entry is broken apart and transferred into the appropriate ledger account. So the debits go into the debit column of the ledger and the credits go into the credit column of the ledger. And the purpose of this step is organization. It is like sorting your mail. You get all your mail in a single chronological stack, the journal, but you want to put your bill with other bills, your bank statements with other bank statements, and so you do the same on the ledger. This makes it so much easier to see how much money you have, how much you owe, and how much you have earned. So you can see where it is going. Sorry. So let's visualize this with a T account we've been using. We'll start with transaction number 1. We have the journal entry that debited cash for 20,000 and credited common stock for 20,000. When we post this, we simply move the 20,000 from the debit side of the cash T account and the 20,000 to the credit side of the common stock T account. The BLA line, which is the balance line, shows the account balance after the transaction. At this point, the cash T account has a balance of 20,000. The common stock account has a balance of 20,000. It is, again, a clear and simple way to see the impact on each journal entry. So again, double entry format. We see the same thing in transaction number 2. We debited equipment for 3,500 and credited account payable for 3,500. To post this, we open the 2 new T accounts. We move the 3,500 to the debit side of the account, the equipment T account, and the 3,500 to the debit side of the account payable. You can see this format continues to be the same as well. Now number 3 is a little bit more complex. We debited cash for 4,000 and we credited unearned revenue for 4,000. When we post this, we add 4,000 debit to our existing cash T account. Okay, so our existing cash from January 3rd is 20,000. Then we add to it 4,000. So now the balance is 24,000. We also open a new T account for unearned revenue and post the 4,000 credit to its credit sides. So this process of updating the running balance for each account is the very essence of the general ledger. That's what it's doing. Now let's apply this transaction that affects the two different sides of the accounting equation. So for example, we have transaction 4, we debited account receivable for $5,500 and credited service revenue for $5,500. We post the $5,500 debit to the account receivable. So T account and the $5,500 credit to the service T account. This shows us that a company owed money that it has earned and that it has earned revenue. This is a classic example of an accrual-based transaction where we record the event when it happens, not when the cash is received. So both accounts now have a balance of $5,500. So for transaction number 5, we debit expenses for $300 and we credit $300 in cash. So we post the $300 debit to utility expense T account. We then go to our existing cash T account, which because it was already there, right? And we do the same thing. And so we credit that. And so that reduces the running balance. So as you see now, it's $23,500. Continuing on, for transaction number 5, we had a journal entry where we debited utility expenses for $300 and credited cash for $300. To post this, we transfer the $300 debit to the T account for the utility expense. And then since this is the first transaction affecting the account, its balance is now $300. There isn't anything else. Oh, sorry, there we go. And so the cash balance, which was at some point, did we just talk? I feel like we already did this. But nevertheless, yeah, we did this one. All right, we're going to move past it. Transaction number 6. The journal entry debited dividends for $100 and credited cash for $100. We will post this by placing the $100 debit in the dividend T account. Since this is the first dividend transaction, its balance is now $100. We will then post that $100 to the cash, which has before other ones, and so it reduces the balance. So now the balance is, it decreases by, there we go, it decreases by 100, which then is 23,600. Transaction number 7, the company received cash for service rendered. So the journal entry debit its cash for 2,800 and credit service revenue for 2,800. So debit to the cash T account, increasing the balance to 26,400. And so this is where we have the, again, running balance. And then on the other side, because the service revenue we had earned 5,500, a service revenue from before, then the balance becomes 8,300. Transaction number 8 is where the company paid off its liability. So we debit account payable for 3,500 and credit cash for 3,500. We will post the 3,500 debit to the account payable T account, which reduces its balance to 0. Since it was previously 3,500, we will also post the 3,500 to cash T account, reducing the balance to 22,900. And then the other one is it balances, so the account payable balances, and now that is at 0. Transaction number 9, we debit salary expenses for 3,600 and credit cash for 3,600. To post this, we add the 3,600 debit to the salary expense T account. We also add a 3,600 credit to the cash T account, which brings the new running balance to 19,300. And this shows how an expense reduces cash and by extension, it reduces equity. On transaction number 10, where the company receives cash from the customer who has previously billed, the journal entry debits cash for 5,500 and credits accounts receivable for 5,500. So we post the 5,500 debit to the cash T account, which brings the balance up to 4,800. So you can see it there. And then the account receivable balances out as well. And so we end up with a balance of 0 for that T ledger. Transaction number 11, the company provides service on accounts. So the debit account receivable for 1,200, and we credit service revenue for 1,200, and we will post the 1,200 debit to the account receivable T account, which brings the new balance to the 1,200. So we will post again the 1,200 credit to the service revenue T account, increasing its balance to 9,500. This once again shows how revenue is earned before cash is received under the accrual accounting method. And finally, this is our last transaction. We debited supplies for 5,000 and credited account payable for 500, and we will post the 500 debit to the supplies T account, creating a balance of 500. We'll also post the 500 credit to the account payable T account, and the account payable previously has credit of 3,500 and a debit of 3,500 with a balance of a 0. So now the balance is 500. And this transaction adds new assets and new liability to company records. So you can see all of it together. So then what do? We put all the assets account in one place. We then put all the liabilities in one place. We put all the equity in one place, and we add them up, and they should give us the same balance. Okay, so what do we have? All the cash, all the accounts receivable, all the supplies, all the equipment. These are all assets. Liabilities, account payable, unearned revenue. Then we have equity, common stocks, dividends, salary expenses, utility expenses. These are all utilities. All right, and it should all balance out. Again, with the sample, we will do that one on its own as well. So this exercise will test your ability to journalize transactions, determine the final balance, and this is a crucial skill. So now, A tells us, prepare the necessary journal entries. What do we have? We have April 25th, the company refilled gas cans for $28. This is an expense. We'll debit gas expense for $28 and credit cash for $28. Now, April 26th, the company has, I think we have them. Oop, there we go. No, maybe not. All right. The company earned 1,200 in revenue and received cash for 75% of it, and remaining cash is on account. So cash is increased by $900, which is 75%. So 1,200 multiplied by 0.75 is how we get that percentage. An account receivable increased by 300, which is 1,200 times 0.25. And that is how we get the 25%. And so the service revenue increased by $1,200. This is a compound entry. We'll debit cash for 900. We'll debit account receivable for 300 and credit sales revenue for 1,200. April 27th, the company pays for advertisement. This is an expense. We'll debit advertising expense for $35, and we will credit cash for $35. So April 29, the company makes $25 payment on the account. This is a reduction of liability. And so the debit account payable for $25 and credit cash for $25. All right, so let's explain why. That's B. Gas expense and advertising expense, we debit these because expenses are contra equity with a normal debit balance. So debit increases the value. Service revenue, we credit this because the revenue increases equity and has normal credit balance. Cash, we credit cash when decreased because it's an asset with normal debit balance, and we debit cash when it increases. All right, account receivable, we debit this because it's an asset and the company is owed money, so its value is increasing. And then accounts payable, we debit this because it's a liability and we're paying off, so its value is decreasing. C, what's the new balance? To find the new balance, you will need to know the starting balance for each and then apply the debit and the credit to the entries and this third step of the accounting cycle, which we will get to in next exercises as well. All right, so we'll also have this one and it's an exercise on its own. My apologies. Now let's move on to the final step of our initial accounting cycle, which is preparing a trial balance. A trial balance is not a financial statement. It is an internal report that we prepare directly from the general ledger after all the transactions have been posted. Its sole purpose is to test the equality of the total debits and total credits. We list every single account and its ending balance. All accounts with normal debit balance go into a debit account. All accounts with normal credit balance go into the credit account. At the end, we sum both columns. The total of all debit must equal the total of all credits. If they don't, we have an error in our journalizing or posting, and you must first find it before you can move on. This slide beautifully illustrates the direct connection between the general ledger and the trial balance. Look at the T accounts on the right, which represent the final balance from our posting process. Now look at the trial balance on the left. The final balance from each T account is simply transferred to the appropriate column on the trial balance. For instance, the final balance for the cash T is $24,800, which is listed as debit on this trial balance. The account payable on the T account has a final balance of $500, which is listed as a credit on the trial balance. The visual connection reinforces the trial balance is merely a summary of the ledger account. It is the final check on our double entry bookkeeping logic. All right, so here's the final unadjusted trial balance for the ones we were just looking at, and this is just, you can kind of see it in a bigger format, and you can go through everything that we went through. We credited, we debited, we did everything in, and now we put it all together, and we see that, well, it's balancing. So again, we will take a look at this on its own as well. All right, sample exercise. Again, we will have it by itself. All right, my friends, that is it for this video lecture. Oops, my bad. I think I missed, you may have or have not heard the other ones. So just really quickly to recap, this is just a closer look of everything that we have done. These two we will do in independent videos. And that is it, my friends, for today. If you have any questions, please let me know. And I will be with you in chapter 4, 5, 6, and the rest of them. Have a great day.